Hello, we're going to talk about balance sheets today. So, balance sheets are one of our most important financial statements that we use. What it really does is it just kind of shows you what your assets are, what your liabilities, and what your shareholders' equity. The key to it is it shows the health of your business. Now, it's only showing you a period of time. So, if I was to run a balance sheet and show today, which is I actually have at the end of the month, but if I ran today's balance sheet, it would show exactly what my company owns, what it owes, and how much I have of that company. So you really want to look at it as a movement to see how is your company doing. Is your company gaining more assets, or is it gaining more liabilities? Are you taking too much money out of the company? So we're just going to break down the basic parts of the balance sheet and how to read it. So it starts off with your cash. So this is the most liquid assets that you have. And then it moves on to other current assets, usually inventories. Now, this particular company does not have any inventory. It does not have any accounts receivable. Now, why I did leave this here on purpose is this is actually a misposted transaction. So when I review these things, if I look at it and I say, why is this asset here? And it's not really an asset, then I'm going to move it. So this particular one I looked at, it is a contribution that I made into the company back last year. So I will fix that before I go to do the tax return by moving it down to my shareholders equity account. So it won't affect my profit and loss statement. It's purely a balance sheet transaction. Now we have our fixed assets. So we own a building. We did a whole bunch of improvements. We bought a bunch of equipment for in here. And this is our fixed assets, less our accumulated depreciation. So we have accumulated depreciation coming in every year. This is an amount of money that I transferred over to help start paying off a loan that we have. It's like an escrow account. Whenever we have a little bit extra money in all of my companies, I go ahead and do this. This particular is our smallest company. It does not contribute much. Accounts payable. So accounts payable is just what we owe to vendors. So right now we owe $47.25.89 to different vendors, most of which is actually the CPA firm. So it doesn't. They're not trying to collect that money too terribly hard. This is more money that's owed to the CPA firm. This is all money that we put in order to do the remodel. We took out a loan through Square, so we have a Square loan payable in here. We have some sales tax that's going to be payable coming up in a day or two. And then we have money that the bakery would technically owe to here. So it should be classified as an asset. I usually leave my due from accounts down here and liabilities, just so that they're all in the same spot on all of the companies. This is the amount of money that we owe to the mortgage company for the building remodel. And then this is the equity account. So this is a partnership. So my wife and I both own this company. So we each have a little bit of equity in here, meaning that we've actually put money into here. As you can see, we've had a loss overall. But hopefully that'll turn around soon. So if you have any questions on a balance sheet or why it's important, by all means, reach out to me. I'd be more than happy to help you out. Other than that, I hope you have a great evening.